We're going to look at placing a value on an existing business in case you would like to purchase it, or if you are selling a business, how to determine the value. The information that we're going to be talking about today is very general. If you do get to a point where you're looking at a specific business, make sure that you have accountants and attorneys, realtors who are used to working with commercial investments. Make sure that you have experts at the table to protect your interests. When working on the value of a business, know that it isn't worth anything until it's profitable. And 1 year of random profit does not a successful business make. You don't even want to consider the business unless it's been profitable for at least 3 consecutive years, possibly as many as 5 if there's any volatility in the numbers that you're looking at. Whether you're buying or selling, your business is worth what the market says it is unless you can give people a reason to believe otherwise. So unless you have something very different to offer besides customer service, you are going to only be able to get a certain amount regardless of what you think it's worth. So the first type that we're going to look at for evaluating a business is called asset valuation. And that's when you take the different pieces and parts of a business and you sell them independently. When I sold the printing company, I used asset valuation. We'd already taken all of the depreciation we could out of the machinery, so it was pretty much worth nothing, and we sold it for what we could. Then we went on to intellectual property, and there was some value in the business name. My parents felt there was more than there really was because they had an emotional attachment to the business. And we also had employees that were going to stay with the business, and that helped create some continuity and that added some value. The final area that we had to contribute was customer relationships. We had negatives, we had historical orders. We were able to sell those as total item, and it was a value because the company, the printing company that took over for that piece had all of the historical records and materials to be able to provide the customers with a seamless transition. Now, when you're looking at a business, you do need to know that chances are you're only going to keep about 25% of customers. Any more than that, and you're very lucky. So when you're looking at buying a business based on asset valuation, if very much value is placed on intellectual property, run, because you don't have that emotional attachment and you're going to be hard pressed trying to convince the owners that realistically the value of their name isn't what they think it is. Or maybe they'll be able to convince you that it is worth that. This style of valuation is most commonly used when you're not going to be continuing a business, so it's being sold for parts. Market approach is another option, and it's the potential that the business has for future growth. And it's also how it compares to those around it. So you start by estimating the size and growth of the market, but be very realistic. Chances are if you're the buyer, you're going to be more realistic than the seller, so you have to find some middle ground. You're going to determine the competition and any industry barriers. For example, in the Twin Falls area, there are a very limited number of liquor licenses available. So that could be an industry barrier that's too much of a roadblock to work with. But the higher numbers in your competition and the higher numbers of competitors and more challenging barriers will result in a lower valuation of the business. Another challenge to the market approach is that it doesn't give much credence to any unique traits of a business. If you do seriously have something of unique value, it's hard to put a dollar figure on it because you're looking at the industry as a whole. A common way that numbers are figured for the value of a business is income flow method. And this assumes that the business will be in operation after being sold. And it also assumes that the business has been making a profit for at least 3 to 5 consecutive years. And please remember, the way that we're looking at it here is a very simplified version. You will want to speak with professionals because these are just estimated numbers. But you'd start with your annual earnings before taxes. The buyer of the business may have a different tax structure, so you don't include that. So let's say you clear $17,000 before taxes. You add to that the annual income for the owner. Subtract any unpaid expenses, subtract existing depreciation. And you do this because you've already written off that value. And then you subtract any one-time income items. So for example, if you have a deposit in place for utilities, well, you would get that back personally. It doesn't transfer with the business, so that would be deducted from the total. Then you take the finished number and you multiply it by 3 to 5, somewhere in there, and that tells you the value that you're looking at. If the business is clearing approximately $17,000, it's going to be worth somewhere between $90 and $150. A lot of variables come into play. What is the customer count? How much are cost of goods sold? What kind of competition is in place? Is there going to be a loan? Is the owner carrying paper on that loan? So there's a lot of details that they need to be able to take into consideration. But this at least gives you a starting point. Another method is the free cash flow method. And in this case, you look at net after-tax earnings, including the owner's salary. You don't include any interest on the existing loans because they would be paid off through the sale. Next, multiply the annual free cash flow, that $80,000, by the number of years that the loan is going to run. So 80 times 4, 320. Out of that 320, you're going to subtract the down payment. So let's say they put $80,000 down, the balance is $240,000. FYI, you'd never want to sell a business if someone does not have a fair amount of money to put down. You want to make sure that they are committed financially to that outcome. Looking at something from a little different point of view, let's say you have a house. You get in over your head, you lose your job. If you have no money, if you have no equity in that house, you are much more likely to walk away. But if you have a fair amount of money invested in that house, you're going to find a way to keep it and to make it work. Well, it's the same for business. If you have money involved in that business, you are more likely going to find a way to make it work. You have a vested interest. So make sure that you don't sell to someone that does not have money down. So back to our figures. So you have subtracted the down payment, which leaves you $240,000. And that's the balance of the amount that's available to make interest and principal payments. And it also provides the new owner with some return on investment. So moving this to the top of the next slide, we had $240,000, and we divide that by 4 years, gives us $60,000. Well, the owner has $80,000 invested in the business and wants to see a return on that investment. And in this case, the owner would like to see 20%, which is $16,000. So that leaves a total of $44,000. That's 60 minus 16 is 44. Then you take that 44,000 times 4, and you know that the money available, including interest for the loan, is $176,000. And for that $44,000, that gives you a monthly payment, or payment monthly, of $3,667. I've included a template in Excel that will allow you to play with different amounts so you can see how much loan, including interest, would be available while staying within the loan payment level of $44,000. So for our purposes, we are looking at an interest rate of 8% for 4 years with 12 payments per year. And the loan amount is where we're going to play, because we want our scheduled payment amount to be not more than $3,667 per month. So let's see how close we can get. Let's try 100,000. And that makes our payments $2,400. So we know we can go more than that. Let's go 125,000. 3,051. We know we can go more. 150. 366. Okay. So the total payment amount that we can do is $175,773 is how much we can borrow in order to stay within our 4 years and our payment amount for the money that we have to work with. Let's assume we don't have an interest rate of 8%. Let's assume an interest rate of 10%. Well, now we're over our numbers, so we're going to have to reduce the number of the amount of the loan. And 140, looks like we still have some more room. 145 puts us just a shade above. 144. We're right in there. So at 10%, we can only borrow 144,000, because with interest, we're looking at 175,306. So an 8% interest loan, 150,000, or after interest, 175,773, or a 10% loan would give us 144,000, or after interest, 175,306 is what we'd be paying. To the loan amounts, we would add the down payment, which would allow us to arrive at the total purchase price. So 150,000 plus 80,000, 230, or 144 plus 80,000, 224,000. And of course, if the lender is willing to lend more or finance for a longer term, lower interest rate, variable interest rate, there are a lot of differences that could change these numbers, but once again, as with before, it gives us a starting point that we can look at for what you could afford or what you could sell your business for based on the amount of interest that you could charge, especially if you're carrying the paper.